Welcome to a really, really great venue. This seminar, the VRIC 2023. I've been speaking here for a couple of years, and I've been doing this for 35 years. And Jay Martin is impressive in terms of the venue, the way he puts it on, the people he gets, and the vendors. It's just exceptional. Today I'm going to talk about something that nobody's worried about. What the heck is the Federal Reserve going to do in terms of inflation, and whether or not they will continue to be data dependent, transparent, and for the most part honest. So I want to tackle that because that's the key to understanding where we're going to be over the next couple of years. You're going to hear things from them. How do you know what to take and what to disregard? So as long as people are interested in that topic, I will begin, and that's good because that's my only topic. So we're living in interesting times, unquestionably. In March last year, we faced a worldwide crisis that was probably the worst economic crisis of the century. Maybe not as well as the Great Depression, but it was really, really serious. And the nature of it was something that we haven't had to deal with on a global basis in my lifetime. And so what we're dealing with is something that is really new to everyone. I've never lived through this, and I'm at least at the 80% of age group here. So that's what we'll start with. The economy itself contracted roughly by a third, but it was the damage that followed that made this situation unique, affecting citizens globally. And I don't remember any time where we had banking crisis here or something in Europe, but the entire world got hammered by this thing, and it doesn't matter what it was, but it turned into a recession. And so it put the central banks globally into a really strong decision they had to make as to how to effectively take an economy that was brought to its knees, where the workforce went from robust to near nothing. And how do you deal with that? How do you rebuild it? And so not only was it the Federal Reserve, but all the banks mentioned. Now, here's the key to the dilemma we're facing. The Federal Reserve made an assumption, a blunder, that set the dominoes going, that once that switch was effectively pulled, it in essence popped the genie out of the bottle, never to return in the same way again, okay? And what I'm talking about is the fact that they assumed that inflation was transitory. And there were no rate hikes. And they kept it there for all the way through March, all the way till March of 2022, with the assumption it would fix itself, and at that point, inflation ran to 8.5%. The chart that you're looking at shows that small period of time where they didn't move rates. And businesses loved it. It was free money. But it was a difficult time. So by assuming inflation was transitory, that blunder set a bunch of stuff into motion that they had to become reactive rather than proactive. And from then till current, pricing in the Federal Reserve's monetary policy is based on this mistake. It wasn't transitory. And so by leaving rates at near zero, they set into motion the hardship that occurred over the last couple of years. And the genie never went back in the bottle. It was a terrible miscalculation. In essence, it took inflation from 0.3% to 8.5 in March, and then it peaked out the next month at 9.1. The chart you're looking at shows you how quick it started to spiral out of control. The numbers are based on monthly year-over-year numbers, and it hit a 40-year high very, very quickly. And that's kind of what it looks like on a graph. At some point, the Federal Reserve had to acknowledge, Jesus, we got this one wrong. March 2022, they hold an emergency meeting, and they say, hey, guys, we got to do something about this. And they actually enacted their first rate hike since 2018. And the question they had to ask themselves is, by being reactive rather than proactive and raising rates quickly, it negated a soft landing. And the question was, how deep of a recession were we going to see? Because my question isn't if there's a recession, but how long it will last. And this chart that you're looking at shows the rate hikes by the Federal Reserve from the beginning, which is on the bottom in March, to December. And in essence, I've never lived through a point in time in which they raised by a quarter, then 75 basis or 0.75%, and then 4 consecutive rate hikes of 0.75%. That is a dramatic change in interest rates. It basically killed the housing market. I mean, the rates you had prior to this were reasonable. Nobody can afford a home now to buy it because the mortgages cost too much. And it peaked out right around 9.5% headline, and that's where we're at. This chart here, what it's doing is we're overlaying the interest rate hikes by the Fed. It's a gold chart, and every vertical line represents the day the Fed raised rates. And what you can see is, at the left-hand side, from the beginning of March, those green boxes is a consecutive series of lower highs. The red ones are consecutive lower lows. Absolutely a full-blown bear market, meeting textbook definitions of what it means to be in a bear market. Series of lower highs, lower lows. And something odd occurred. During November, people started to believe that the Fed is actually going to cut rates. It was wishful thinking, but market sentiment shifted in gold, not because of a real action, but because of the belief that the Fed's going to ease up on the gas pedal. And in purple, I call it a triple bottom. November the 3rd, it hits a low of 1621. We've moved so fast I get confused with the numbers. And in a few months, it's gone from there to almost $2,000. That's the last half of that chart. They released a thing called the dot plot at the December meeting. And the dot plot is in their economic projections of what they plan on doing in 23 and 25. Their projection is they're going to get interest to 6% and keep it there for an entire year. Many analysts, including myself, believe that's unsustainable. It's already pretty much crashed the housing market because it changes the entire schematics of how much it costs to borrow money on a 30-year loan. That's why homes dropped. It has created a scenario in which we are forced to pay a lot of borrowing costs that we didn't have to pay before. Money was cheap, now it's expensive. That's that bottom line. And the way I look at it is you can see it in the gold price because unlike fiat currencies, gold has an intrinsic value. And so it raises questions. First question is there going to be a recession? My question is, there will be a recession. That's my opinion. How deep will it go, or will it be shallow? The next thing that they're going to ask themselves is how that will affect the economy and, for the middle class, their ability to live and meet their necessities, such as food, clothing, prescriptions, stuff like that. The answer to that question, honestly, is we need more data, but now I sound like the Federal Reserve. My sense is that they are digging themselves into a deeper hole because the Federal Reserve, especially Powell, was built on the idea that they would be transparent and honest with the American public and tell them what they're going to do ahead of time. In all fairness, it should be that way. And add to the fact that we just broke the debt ceiling, which Yellen announced last year, which means that we're broke, and to pay our bills, and they will pay our bills, but they're going to have to raise the debt ceiling. The real issue is we spend more money than we make. I'm talking about the government. The Federal Reserve can do so much, but it is nothing will work without a unified front with the administration, the House, Senate, and the President, and the Fed. Because if they continue to spend more money than they have, it cannot get better. It will only get worse. So will they do that? You decide. As far as the Fed goes, they're pretty good at doing their task, but they're no longer transparent. Will there be a recession? Opinion, yes, absolutely. They have to, by virtue of what a recession is, which is the decline of 2 consecutive quarters of GDP. Of course. Why? Because by raising rates, it creates that scenario to be overcome. So, bottom line, why am I a gold specialist? I'm an analyst. I do a daily blog on Kitco Media. Those who follow gold know who I am. Why am I talking about the Fed when I've shown one chart about gold? It's because gold has maintained a value for its entire life and roughly follows inflation. Negative, it doesn't bear interest, it doesn't produce anything. It's just a rock sitting there. But my belief is that during this year, we will go to a new all-time record high by the end of this year. Record high is just 20 and change. And I'm looking for 2350 by the end of the year. So if you buy bullion, you buy mining stocks, you trade futures, this is a year to look at those precious metals products as a good portion of your portfolio, however that works out, whatever that means. Gold's an important thing to own, and it's more important now than I believe it has in 50 years, 60 years. And the only thing I want to take away with you is that there is a war between countries to take their currency to zero, to devalue it. Gold will, in many ways, protect that equity from just getting annihilated. And most importantly, stocks over time always make money, but there are periods of time when they don't. Have a good portion, a percentage of your money in gold or silver. My name is Gary Wagner, and I thank you for your time.